I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Sean Fenton, Chief Investment Officer of Sage Capital. Sean, can you explain the investment process and investment philosophy of Sage Capital? You do long, you do short, Aussie equities.
The investment philosophy really sits around identifying what we're good at, where we can add value, and where, in modern markets, things fly around, where we need to control risk. So our real focus is on what we can add value to and get some insight into, which is company earnings and what drives those. Whereas we look more broadly across the market, it can be thrown around by sentiment, liquidity, and big shifts in style. So we look to control those things. So the process itself is very broad. We believe that investment decisions can be complex, and to make good ones, you need to bring in as much information as possible. So we've got a broad, systematic process that ranks stocks on a range of different momentum, quality, and value factors, and a fundamental process that looks at really understanding those company earnings, what drives them, and in particular looking at what might change there and provide good investment opportunities. So we bring it all together by really looking to apply that process within broad groupings of stocks we called Sage groups, and that enables us to add value through those company specifics, what really drives earnings, while being pretty neutral to broad segments of the market and not exposed to the uncontrollable market sentiment and big style swings that can occur.
Sage groups, can you explain that a little?
Traditionally, you look at the market, you might look at sectors like banks and building materials or resources or something. What we've done is tried to come up with some broader homogenous groups within the markets where these stocks behave in similar ways to different market environments, be it a strong economy or rising inflation or falling bond yields. And as a consequence, we can make better investment decisions by focusing within these groups. So we've got 8 of them. They include things like domestic cyclicals and global cyclicals, more defensive stocks, which will be like telcos and utilities and the like. Resources, we split into basically resources, and we take gold out, which can be quite volatile. Then we've also got growth stocks, which is a very important category because in the current environment of bond yields falling and bouncing back, you see big valuation shifts across that part of the market. And then lastly, we've got REITs, which are property trusts, and yield, which is like banks and insurance and the like. So that those homogenous groups allow us to control those real broad thematic risks across the market by keeping reasonably tight exposure within them in our portfolios.
With COVID, have you seen any change in valuations or valuation philosophies or valuation metrics, or is it more of the same?
I think COVID's really accelerated some of the changes that we've actually seen post the GFC. So with that huge financial crisis, a lot of the financial system broken, central banks really stepped in to try and actually allow asset prices to rise, and corporates, businesses, governments to deleverage, and they put real interest rates down at negative, very low levels. And that's really driven a broad lift in valuation multiples across that long duration part of the market. So stocks that have either long growth or stable earnings, and you've seen big expansion in market valuations. And COVID, with the prospect last year of maybe going to depression and deflation, saw extra boost of liquidity. Central banks all cut rates to zero again, big bond buying programs, asset injections, real yields suppressed again, and we've seen once again an explosion in valuation multiples, which is now starting to reverse as we get some vaccines and the economy recovers and markets recover. Bond yields started moving up, yield curves have started steepening, and you're starting to see rotation back towards earnings growth and cyclicals and a little bit more value, and that more expensive end of the market's coming under pressure as valuation metrics are starting to normalise across the market.
So the momentum stocks, where are they now?
The momentum at the moment, ironically, is probably more with cyclicals and those that have actually been most heavily impacted through COVID and are moving towards reopening. So we see broad momentum across some of the industrial stocks, things like steel, like BlueScope Steel. You've seen housing prices, but also housing construction and household formation take off. So builders like CSR, and in the US, James Hardie, doing very well, as well as broad reopening. So travel, despite being in the doldrums, with the prospect of reopening and recovery and expectations of earnings lifting again, they've actually got great momentum within the market.
Of course, you do long and short. Can we talk about short for a minute? What's the process, and is there any themes or protocols in your whole shorting philosophy and practice?
We look at things pretty symmetrically across our investment process. So, as I touched on earlier, we've got quite a broad process. So the systematic ranking side will actually rank stocks across the market and within our Sage groups from best to worst, and we do look fundamentally to add more depth and insight there, really understand where company earnings are going and what's priced into the market, and that can come up with both long and short ideas. But that investment process is very broad and will give us a range of long and short ideas within each of those groups. So it's a very natural thing for us to go out and short a stock. And the key there is we're not necessarily looking for companies that are going to certainly go broke, or there might be frauds or worth nothing. We don't need the stock price to fall in absolute terms to make money out of that long short structure. We just need to make sure that what we've shorted, we've invested the money that we've crystallised from that shorting into a stock that does better. So, for instance, in resources, we might be short iron ore stocks. They might keep going up. That's fine if we've bought some copper or nickel stocks that have gone up even more. So that system of longs and shorts has made money, and that's the whole idea of the long-short structure and those Sage groups, that we can get more exposure to our investment insight by being short underperforming companies, long outperforming companies.
How difficult is it to sell the long-short story to investors? Do they get it, or is it a difficult discussion to have?
It's certainly a point of friction in that it's something a little bit different that needs to be explained, but it's not overly technical or too difficult. And I think once you change your frame of reference from what I was talking about of just investing in stocks in terms of absolutely are they going up, to what we're trying to do is use the long-short structure to add value on top of the equity market. So for our equity fund, it's got exposure to the equity market, the long and shorts adding incremental returns through stock selection on top of that. Or we've got an absolute return fund as well that balances the longs and shorts. It derives value from our relative stock selection with no exposure to the equity market. And once you reframe the investment decision into that terms, that shorting's not about betting on things that are going broke or dying. It's just they could be falling more in a falling market or rising less in a rising market. Then it's just a natural way to express your investment skill and particularly enable you to drive returns and actually have a broad diversified portfolio. So it's not just adding extra value from shorting in stocks that are underperforming, but it enables you to do what we were talking about in terms of having broad neutrality across the Sage groups and not having style bias or cycle bias there. We can run very diversified portfolios. So it enables us to really get the best of both worlds, strong diversification and greater exposure to our stock selection abilities.
Well, quant plays an important role in what you do. Can you explain the quantitative component of your process and how it relates maybe to both shorting and going long?
Yeah, sure. So the quantitative process is really all about exploiting behavioural biases in the market that lead to inefficiencies. So at university and school, we're all told that the market's perfectly efficient. Well, it obviously isn't. And the reason for that is people process information in different ways. There's full of speculation and all sorts of things. And what you find is that sometimes information's systematically neglected. And the quantitative process is all about capturing that information and exploiting it. So it falls into a range of factors that look to rank stocks. And these include momentum, quality and value. And very simply, momentum's trying to identify things like anchoring and confirmation bias, where people underestimate the impacts of changes and what's occurring across the economy or within a company, and the fact that those changes can persist for a period of time and lead to a succession of surprises on the upside or the downside. Momentum's very good at capturing that and exploiting it. But momentum can also become overstretched, as we were discussing. It can see valuations really blow out and become extreme. So you do need also quality and value measures within that process to ensure that when a stock's become too overpriced and people have recognised the momentum and got on board, that the risk return there starts to deteriorate, and you might actually want to be short those stocks that have become too expensive. So we've got a very efficient process to gather that data, measure it, and we've both got the ability to test how those factors have performed over time, but we've also been running that process live for a couple of decades and understand how the market works in different environments. So it's a very efficient way for us to get a very good base view of how stocks may perform. It really forms the foundation of our investment process.
Well, we're in the middle of the first half of 2020. What's going on in your quant division at the moment? Just to put some meat on that bone so people can understand.
Yeah, the interesting thing about the quantitative process and particular challenges that it faces is those periods of extreme volatility that you get and that we saw last year through COVID. So, as I mentioned, it's great at leveraging behavioural biases in the market. And when you get reasonably steady state markets and things moving around, it's very powerful. But when you do hit periods of extreme volatility, like economies being shut down as everything goes into lockdown with a global pandemic, then the reality of the current economic circumstances can overwhelm those behavioural biases. So we actually turn off some of our quantitative signals in that environment, our momentum signals, because our experience has shown that they don't perform well.
And are they turned off at the moment, are they?
They're starting to come back on at the moment. So then you've got to go through the period of economies going back to normal, reopening, and everything's bouncing back, and those new trends start to emerge. But it's in the process of coming back at the moment. So
does this mean you're expecting more volatility in the immediate future?
I think there's some risk of volatility in the immediate future as we go back into reopening and bond yields are moving up and yield curves are steepening, but not to the same extent that we saw last year. I think it's more volatility in financial markets and asset prices as opposed to volatility in the real economy and earnings and big shocks there. You just need that volatility to wash out of some of the signals before you turn them back on.
What do you do if there's a conflict in your fundamentals, assessing shorts and longs? Does that occur or not?
It certainly occurs, and we look for that. So our fundamental process is independent from our quantitative one, and that means we can get unique ideas and insights. We're going into a lot more detail, capturing a lot more information on the fundamental side. So
well, what wins out, fundamentals or the quant?
They get weighted, so the quant still has an influence, but because the fundamentals more concentrated, more high conviction, there are generally fewer of those views coming through, they get a higher weight. So for any individual stock, when there's a conflict, the quant will have an influence, it'll moderate some of those fundamental views, but ultimately the fundamental view has a little bit more influence, will tend to win out in that scenario.
It's said that 1% of returns can be lost in the process of selling. What's your criteria for closing shorts and selling longs?
It's a very important discipline for any investment manager, and it comes back to one of those behavioural biases that I mentioned, confirmation bias. When people have a position, they naturally go out and seek information that confirms their view or interpret things in a way that confirms their view, so they can hold on to bad positions for too long. We really combat that by having a team-based approach to decision making. So with the four of us, we split the market up in terms of where we focus on different sectors and groups within the market. But when we make our investment decisions, we really come together as a team, and there's always someone to play devil's advocate. We're quite diverse in terms of the way we view companies, our investment approaches and our investment styles. So there's always someone prepared to argue the pros and the cons of a particular stock or position, and that helps us overcome that confirmation bias, look at things always with a fresh set of eyes and challenge positions in the portfolio when new information comes to light, and more rapidly say something's changed here, we need to address it and adjust our portfolio.
To finish up, can we talk about your thoughts, your most positive thoughts in terms of the Sage groups at the moment? Which particular groups are you hot on? I
think probably the global cyclical group is one of the strongest at the moment.
Give us an example of a few companies in that.
So an example there would be something like BlueScope Steel, which has got great exposure to US steelmaking spreads. You're seeing broad industrial recovery there and shortages in a lot of supply chains. So steel spreads have gone out to very high levels, and with restrictions on imports into the US, it's probably going to be sustained for a while. They've also got exposure to building and construction in in housing. So they've got colour bond, which goes into a lot of renovations and new builds in Australia and around Asia as well. So very strong balance sheet, net cash, benefiting from that broad upswing in industrial activity around the world.
It sounds like you're relatively optimistic about the immediate future in terms of markets and investments.
Pretty optimistic in terms of broad economic recovery, but that said, equity markets are trading at record highs and valuations are stretched. In the background there, you've got bonds starting to sell off and yields move higher. So we might hit a point where we get out of the Goldilocks zone and good news becomes bad news. And we've seen that in the past with the taper tantrum coming out of the GFC as bond yields rose and market sell off. So there could be a period of market correction if bond yields sell off, if growth and inflation pick up too much, things get too good, and some of that stimulus from central banks starts to get taken away. You might actually see volatility and correction in equity markets. So it's something you've always got to balance up in your decision making.
Were you surprised to see the Reserve Bank Governor talk about keeping our interest rates at this current low level for so long, for 3 years?
Not really. I'm not entirely sure he really believes it himself, but that's the message that central banks want to give. They view setting expectations as part of their policy tools. So setting expectations that rates will stay low, encouraging people to go out, businesses and households to borrow and drive economic activities, what they want in this recovery phase. Whether they regret that a year or two down the track, we'll wait and see.
Sean Fenton, thanks for talking to us today.
Pleasure.